Good morning, everybody. This is Jeff Scott. This is July 26, 2015. This is approximately 9:30 a.m., and this is my weekend review. I've entitled today Warning Flags, and you'll see what I mean by warning flags. Thanks for joining, and let's get started. As always, I start with a disclaimer. This is for educational purposes only. Anything I recommend should be considered in the spirit of education and not investment advice. I am a doctor, not a licensed broker. I am not affiliated with any software companies. Everything I use, I have paid for, and no one pays me to promote positively or negatively anybody's program. Trading involves risks. You and you alone are solely responsible for any investment decisions you make. I call what I do the Be Your Own Guru training. And my whole idea is to do, as I learned from Ian Woodward in this picture here, great guy, is that not to tell you how to trade, but to give you some of the tools so you could teach yourself and become your own trader. I am based with CanSlim knowledge. I started with O'Neill. It was enhanced through Morales and Catcher with things like pocket pivots, Bible gap ups, voodoo, volume, etc., as well as the new book by Gil of shorting. Ian and Ron partnered with George Roberts of HGSI Software to create a tool that does much more than CanSlim, but really automates the CanSlim process and takes it one step further with Ian's suite of additional indicators that I use throughout, Eurekas, Phoenixes, Kahunas, etc. Ron's done a huge amount to support our community and is Ian's partner in Woodward and Brown Investing. Alexander Elder, not related to HGSI, but I think he's written some very good books. His Trading for a Living has a new edition. That's the book I'd start with. Here he is with his partner, Kerry Lavorne. I've been a participant in their spike trade for years, and I always learn from Alex. I'll finish with John. Ann Cooling, Volume Price Analysis, a very inexpensive book on Amazon, but really gives you a great perspective of volume and price and what it means, much cheaper than buying a $4,000 program. In fact, in the HGSI community, courtesy of Ron Brown, we have an excellent add-on for for Thinkorswim that basically duplicates an expensive program with volume price analysis signals. Van Tharp, position size and money management may be more important than everything else that we do. We've actually dedicated time for that in my live seminars, and I don't think it's spent enough time at most meetings, but Van Tharp would have you believe that it doesn't matter what stock he buys, and maybe even when he buys that stock, it's how he manages the trade with stop loss and position sizing, and I agree with him based upon what I've read and what I've done. Tom Dorsey, I'm by far not a point and figure guy, but Tom Dorsey is all about comparative relative strength, which is what I do. And lastly, John Person, my friend, mentor, teacher, trading buddy, and author of some great books. I've become fast friends with John since I moved down here the last couple of years. Actually, a couple days a week, I have the great opportunity of sitting in his office with my own desk and trading, and just great opportunity to learn from a master. Highly recommend his book, and we've actually started a user group of folks that own his indicator package, lifetime indicator package for TradeStation. I guess if you have Genesis, that's fine as well, and our HGSI users. And I'm leading that group and showing how I bring the two worlds together and streamline my trading for great results. And John will come in and out of the group as well to help us learn his tools as well. Contact me for more information. I use a lot of programs, or I have a lot of programs. This is what I need. I need a trading platform, and I think there are benefits to TradeStation and Thinkorswim, and the benefits are not the same. Genesis is probably the best platform of all, but that is an expensive platform, and although it's provided by some futures companies, it's not provided by the traditional stockbrokers. From a stock market group analysis, I live within HGSI. That's really the nucleus, the central, the brain of what I do. EdgeRater is a great supplement. Seasonal analysis, I use a number of different programs. Probably won't go much into seasonality today. And then I use a lot of different websites, some of which are listed there. Market thoughts, we continue in the topping process. The diamonds broke below their 200-day SMA, and the spiders and the Russell are approaching it. That's concerning. It might be we're coming to a good bounce point, but it also might be breakdown. Canaries resisted the carnage, and we have highs with Amazon, Facebook, Netflix, and Google. If you change the position of Facebook and Amazon and take the first letters, you have FANG, which is Kramer's new buzzword. He loves FANG, and he's not talking about Diamondback Energy. The number of leading industries is as small as I've ever seen it. There's only 3 industries that had a 2-day force positive on Friday: life insurance, healthcare facilities, and interestingly, miners, although they were down on the week, they had a pretty big reversal on Friday. I did my usual 500-plus chart review, and to be honest, it wasn't easy to find great setups on the long side, except for Contra ETFs, which we'll look at. And I guess I'd sum it up. We are at critical support. Over past several months, we've reversed higher from this point, but is it different this time? And I think that I'm concerned, and you'll see why with some of the warning flags that I'm going to show you. Let's look at my sector review Friday, and those who've been here before know that one of the things that John prepared, anybody could prepare this, is basically a real-time breakout of the major sector ETFs and their components. And just red is bad and green is good is sort of the phenomenon of what I do. And the only green I see is in gold, except for FCX because it's got copper, some green in utilities, some in technology, especially Facebook, Amazon, and Barilla. But for the most part, I would say that's kind of red and ugly. Here's the major markets, ETFs. The spiders broke through the 50 and are approaching the 200. The diamonds have broken through or getting to where it bounced the last time, so maybe getting close to a bounce point. A breakdown here may take us all the way down to here, and we'll talk more about that in numbers later. The Qs, like the NASDAQ, have held up, well, excuse me, the Qs have held up better, even better than the NASDAQ itself. I think I'll show you the AD line on the large stocks is much better than on the smaller stocks, but it's approaching the 50 as well. IWM approaching the 200. The VXX remains muted, although you can't tell here. There's a little blue arrow. A person buy signal came in on Friday. And then the dollar really didn't do much this week. So what I found is really impressive here is what's happened with the diamonds and its components, the utilities, which maybe will bounce if the market sells off, and transports, which continue to lag. Interest rates, a big story here. Not much happened this week. We have resistance over here where this white line is. We failed at it, and we continue to pull back from resistance. Rising interest rates, good for insurance companies and good for banks, especially regional. Falling interest rates are good for utilities, dividend players, MLPs, and REITs. And many of those stocks made my top stock list, although, as I said, there weren't a lot of awesome setups this week. But interest rates, small pullback, kind of stable. This is one of John's base screens for those of you that are Genesis Trade Navigator users. And I've got it set here at 5-minute bars on the top, daily and weekly. And this is what I'm monitoring during the market day. And you could see that the S&P futures are in a daily sell signal, still in a weekly buy, interestingly. The NQ100s went to a daily sell signal on Friday. And you notice this little red line here, that's monthly resistance, right at resistance. Okay, still in a buy weekly. The TF, the Russell futures, have been in a sell now for several weeks. They're currently the weakest, and they entered a weekly sell on Friday. And you can look at the NYSE in a daily and a weekly sell, and the Dow futures in a daily sell, but still a weekly buy. Now, you can't see it very well here, but you notice, for example, on the NASDAQ futures, we're right off of a new high, yet our accumulation distribution, our OBV, have been selling off. One of the things I love about Trade Navigator is it has seasonality, and you can see seasonality is projected to sell off this week. S&P, we are just a few weeks out of an all-time high, yet the A&D line in the S&P has been selling off for quite some time. So there's plenty of divergences demonstrating even though the markets have had some higher highs, they're not confirming with volume and with accumulation and distribution lines. I'm a big fan of Lowry Research. They have called the bear markets the last several. They're kind of famous for it, as is Investec Research, which is Jim Slack's organization. And I follow them both closely. This is from Lowry's website this weekend. Their special sauce is this buying power index, one of them. And when the red cross, the selling pressure is above the buying pressure, it forebodes bad things for the market. We had a bearish cross on, I think, Thursday. But you now have selling pressure exceeding buyer pressure. You can see the numbers here. That suggests that we have at least a short-term or intermediate-term sell-off coming. The other thing that they do that's really interesting is they take the NYSE, and you notice the advanced decline line is trending down. It's right about at the moving average, broke below the moving average. They have an NYSE, that's the operating companies only of the NYSE. So they've taken out the bond funds and the preferred shares. And it clearly, if you actually could, it doesn't show up great here, but if one looks at the rate of descent, there's much more decline in the AD line on the operating companies. You have falling AD lines for NASDAQ, S&P 500, and the S&P 400 all look like they've topped and started to roll over in advance of their indexes. So I've got bear flags. I'm not talking about bear flags as a chart pattern, but bear warning flags. How about divergences? This one's crazy. Here's the NASDAQ in price. Or is this the spiders? No, this is the NASDAQ. And here is the AD line of the NASDAQ, not conforming a new high. Here's the NASDAQ 100, where the AD line and the NASDAQ are superimposable. What that tells me is that if you look at the NQ100s, NASDAQ 100 futures, you don't necessarily see a divergence between the NASDAQ 100 and its advanced decline line. However, when you break out and look at the full NASDAQ, clear divergences in the AD line. If you look at participation at new highs, all right, so this is looking at the S&P 500. And the S&P 500 is in yellow, and in white you have the percentage of stocks above their 200-day SMA and above their 40-day SMA. And you could see that despite the market moving up, this number is clearly moving down, which means you have less and less stocks participating. The other thing that comes from this analysis, in my mind, is you have, here's your percentage of stocks participating. You have not gotten to the lowest low when the market has reversed. At 30% of stocks above the 200 SMA, this reversed at the end of 2014. We got as low as 20% in 2011 in the big pullback before the market reversed. We may have further to fall here. Same thing on above the 40-day SMA, where we have less stocks participating as the market goes higher. That is divergence. And that is some other foreign woman asking to be added to my contact list. No thank you. Another interesting thing that I found intriguing. This is the Russell, advanced decline line on the Russell. Now, unfortunately, I think I overlaid it with the spiders, but I think the message is still the same. The AD line on the Russell 1000, the large stocks, is mimicking the market. On the small stocks, you're starting to see some breakdowns where you can see the AD line is falling as the market is reaching new highs. Not a shocker that the Russell 2000 is leading this market lower. So you have divergence with more, a divergence on the small stocks than the big stocks. The canaries are still doing well. In fact, canaries are still above the 8-day exponential moving average. So these are the ultimate of the big stocks in the market. But if you think about the canaries, Facebook is close to new high territory. They report on Tuesday. And my guess is there's a lot of people holding on to Facebook thinking that you're going to get the same kind of a move as you saw on Amazon and Netflix. Netflix, Google, Amazon, the other parts of the thing, all have had major moves but have given back some. Apple laid an egg on its earnings. And then you have LinkedIn, Tesla, the others. So despite the big moves up, we're struggling here at the top on the canaries. I can look at this two ways. If these are leading the market, they have not by any means broken down, and perhaps this is a bullish chart saying that this market may recover and move higher. And the reason why we have indexes of leading stocks is because we want to, what's the term I'm thinking of? We want to get warnings of what the market direction is going to do. And this looks like chop. It doesn't look like dying. The other thing is to say is despite the Amazon, this index couldn't make a new high, and perhaps that in itself is more bearish. Now, why do I do all this stuff? Not to fill up time, because I spend way too much time on this anyways, because I've got to know where we are, and I am more concerned than I've been in a long time. I've said over and over again that you can take off this top, and we're just in this little trading range and chopping around. We are either going to break out to new highs, or we're going to enter a correction phase and potentially a bear market. I think that once again we're sitting in this circle, and unless we see a big change on tomorrow or Tuesday, that we are at risk of rolling over here. Now, that's a broken record, and we have bounced here in the past, so let's hope that we bounce if you're still too far long. But I think we are in a dangerous position, and therefore you have to look at where you are. And I can tell you on Friday and Thursday, I started selling bear call spreads. That means I sell a close to the money call and buy one out of the money further to protect myself and put premium in my pocket. I bought puts on certain positions. I sell calls nakedly against my own, well, not necessarily naked, against my current positions, and typically at the money calls, so I get decent premium. And if I'm keeping the stock long, I can make money even if the stock goes nowhere. I haven't started shorting stock yet, but I did start buying Contra ETFs. I spent a lot of time this weekend looking at stocks to short, and I found quite a few where their relative strength compared to the S&P 500 have caved, and the stock prices haven't yet caved, and I think those will be some leaders to the downside. So we're still in between these two, which means cash, smaller position, selling premium makes sense, but I'm about to take a more aggressive, I've already taken some aggressive positioning, preparing for the downside. This is a busy earnings week. The news is modest, although there's plenty of things out there. And actually, let me take this back. The news is a big time because on July 29th, we're going to get a rate decision from the Fed. I don't think anybody expects in August or July for there to be a change. But with Greece sort of quieting down and China maybe being stable, I think that part of the market sell-off is concerned that the Fed's going to telegraph a September raise. I'm in the camp, let them do it already. I'm done with hearing about it. The first raise isn't the end of the market. Let them stay data dependent and not just raise for the sake of raising. But I'm not sure that a quarter point raise here and even a quarter point raise in December puts us in a restrictive posture. But I mean, obviously for a lot of folks, they'd like to see no raise. That's the big news. There's some sediments, there's some claims, there's inventories on crude and some home sales. But I think all eyes will be on the Fed at 2 p.m. on Wednesday. And I added this comment here. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. That comes from me. Here's a source of information on Leave It Brothers where I get this. You need to know on every one of your stocks when earnings are coming, and then you can make an informed decision. Don't be a victim. Be involved in that decision. So as always, these have been a lot of introductory comments. We'll take a look at the market, some top-down analysis, and maybe some bottoms-up review, and maybe I'll spend a few minutes talking on some of my favorite ways to play the market downside. A quick announcement for the HGSI PUG group. I just added a movie into your Dropbox for Scanner. I will be following up tonight with a movie for my indicators, as well as sending those who are entitled to them a link to download and install my indicator set. You'll have some work to do to get your scans set up, but I will try and shorten that by doing them on my own and sharing them with you. I just don't know for sure if they're going to be to work on anybody's machines except for mine. Again, all owners of the John Person Lifetime Package and HGSI who participated in the June meeting or who have contacted me otherwise will receive my setup later today, and we'll be sending out an invite for Wednesday at 9 p.m. for our first live meeting. And again, if you're wondering what this group is, this was formed at the June meeting. It's a closed group dedicated to advancing trading with the integration of HGSI with the real-time trading system developed by John Person. Membership is limited. Anybody who owns HGSI and is a lifetime owner of John's indicator set for TradeStation is invited as a full member. I always like to support those that support me, so anybody that's been a paid attendee at my previous live meetings may also contact me for admission to the group. The goal is to improve our trading results by integrating end-of-day HGSI and intraday with real-time charting and signals on an intraday charts. And contact me by email hgsidoc@gmail.com for more information. And see you in Florida next year. So, how bad was last week? Actually, for me, it wasn't as bad as I thought it was. I know it was a bad week, which wasn't a surprise because the prior week was a great week. I hit the wrong. So, I always like to run my group performance analysis. This is from end of day Friday to end of day Friday. It's not a perfect analysis because I'm assuming an investment of $1,000 in every stock. So big stocks like Amazon may have 2 shares. But I look at all the different groups that I monitor on a regular basis, and one can see there's ends at 119, starts at 17. So there's 100 different types of groups. Some are bullish, some are bearish. Some are from MarketSmith, some are from IBD, some are from Metastock, some are from HGSI. First thing I could see is this week I only have 4 groups that are black, and I've got a lot of groups that are red. I can see that the S&P 500 was down minus 2.21, and the stocks that made up the HGS 100, which were only 77 stocks, 2/3 were negative, and they were down 2.23, about the same as the S&P. I look for the IBD 50, which is a smaller group of stocks. Most, over half were down, but they're down were only 0.59%. The GIF All-Stars, the stocks that made it to most of the smart groups, were down 0.8%. The MarketSmith was down 0.94. My holdings on last Friday were down a little bit over 1%, and my buy list was down 1.8. I don't necessarily take the stocks on my buy list. My buy list, by definition, are bullish list, and when the bullish lists do poorly, I don't expect my buy list to do great. I expect it to outperform, or else I should just buy spiders, and it outperformed, less negative. But it's really a long list. I don't necessarily take longs on bad weeks. Hindenburg indicator, this will be a sign of market turbulence. We saw one on Thursday here, and I was concerned that maybe we're going to see a series of them, but I think I got bigger concerns. This is the number of stocks in the NYSE that made a new high on Friday. 1.06%. This is the number of stocks on the NYSE that made a new low. When you see 12% of the stocks making a new low, almost 13%, this market is in a world of hurt. And I think that's the highest number that I've seen in years on the percent new lows. Now, had we been above 2% on the new highs, then we would have had another Hindenburg. So I think this market is in challenging straits at the minimum. Bucketology, this might argue for a short-term bounce this week, as we have over 20% of the stocks in the S&P 1500 are now trading below their lower Bollinger Band. 71% of them are trading below the midline of the Bollinger Band. This is a level where we often see the market bounce. However, let me open up something to show you. I still believe in that, and I still think that's important, but let me show you something from my recent meeting. Hope I can show it to you. Where is it? It's got to be a PDF. Okay. Here we were October 10th. We had 35%. We're trading below the S&P 1500. On the 1st, we were at 55%, or excuse me, 35%. And on 9/25, we were at 30%. So we kept getting lower. Oh, hold on a second. Sign in now required. I can't believe you're doing this to me. It does pay to have kids in college. You can get discounts. But no one saw me do that. So I put here how bad was today, going back to 1994, This was like one of the worst days ever. And I was trying to decide whether that meant for sure we were going to bounce. So I looked back to 2008 at the top of the market. And what I saw was it can actually, in a bear market, you can stay ugly for quite some time. This is 10.2, 10.6, 10.7, 10.8, 10.9. And you could see we got worse and worse and worse and worse. The point of that is not to scare you. The point of that is to say that if we go into a bear market, we can get a whole lot worse here, and that it doesn't mean we have to bounce here. What's also bothersome to me was this was the low of the cycle July 8th when we were above 25% below the lower band. And this was the best we got, which is a little bit above 50-50 on July 14th. So we never even recovered from this number. We just got a little bit better before we got worse. I find that bothersome. I look at the markets, and whatever optimism I had here is starting to look a lot more choppy or more ominous as red is appearing on my major markets, telling me that we're going back into chop or something worse. I do a number of other analysis here, including seasonality, and there are some places where you might expect strength. This is a historical performance. I'd highlight this group here of 1 month performance, and you see we do have some good actors. CF has been up 6%, 9 out of 9 years. As an example, Eldorado Gold has been up 8%, 10 out of 12 years. Skeechers has been up 6%, 13 out of 16 years. But there's also some bad seasonality right now. For example, CPLP has been down 8 out of 8 years, averaging 12%. Mankind has been down 9 out of 11 years, almost 10% down. So this is not an easy time of year where there's a lot of layup stocks. In fact, if I'm up 10 out of 13 years on treasury bonds, gold, bond shares, treasuries, bonds, I think those are diamonds D, not exactly an argument for growth, is it? All right, so at best we're at risk here. Now let's go into my trade station, look at my elder and person indicators on the major indexes. Start with the NASDAQ. So again, for newbies, I'm looking at 2 or 3 things. I am looking for the color of the price bar. Elder teaches us if this price bar, this is using an indicator, not just a typical price bar, his impulse release. If the price bar is red, then that tells me that I have to be, I'm okay to be short, it's okay to do nothing or hold, but I shouldn't be long. If it's green, it's okay to be long or hold, but I shouldn't be short. The cyan or magenta dot is a person sell signal. The blue or cyan, I think is the color dot, is a person buy signal. I look at my high jump, which has come off the top, and I look at daily, weekly, and monthly. So very quickly, NASDAQ daily's on a sell, weekly's on a hold, monthly's on a hold, person's on a sell. High jump is not an issue. Weakness in the NASDAQ. Got to be careful. The Dow has gotten hammered, much worse than the NASDAQ. The NASDAQ just turned red yesterday, had been green up until Tuesday. The Dow has been in a sell signal for 4 days, turned on Tuesday, and is already down below the lower channel line. You can see the high jump is down to 25%, and we are red in daily and weekly. Very weak, perhaps getting to a point where you might expect a jump. The NASDAQ 100 in a sell signal for several, or the S&P 100 for several days, went red here, red, also very weak. The semis, finally I can show you something new. Semis are decimated, and they had a counter trend rally here, which really didn't do much, went sideways, and then a new sell signal came in on person in a continuing to sell. You notice that just because it hit new lows, it didn't mean it got below the envelope, didn't mean it couldn't get lower. These green dots are good to see because they're suggesting divergence. And in fact, if you look at this, if you look at the MACD histogram, the histogram's gone down back to 0 despite making lower lows. So those tell me that there's potential MACD divergence, which could be something that we might see before reversal. But boy, does the semiconductor index look awful. The spiders. Sell, sell, sell. Enough said. Just on the futures, the ESs look just like the spiders and a clear sell signal. The NASDAQ 100 just went to a sell signal on Elder on Friday, on Wednesday, on person, high jump heading down. But you can tell there's still a green on the weekly, so a more fresh signal, but still caution. On the Russell futures, these are leading the market down. You could see that here. I showed you some of the divergences where the 200 doing much less than the 2,000 doing less than the 1,000 weekly and daily in a sell signal, person in a sell signal. And then just for comparison with the ETF, it looks the same exact way. So anybody have any thoughts upon market strength? Yeah, the market's weak. Easy to say. Now let's go into HGSI. And let's go into Major Market Plus, courtesy of Ron Brown. Let's go to the let's go into top down. So it's all price and volume heavily weighted to the last day. Raw combo, the strength of the market is bonds, volatility, utility, dollar, silver, and gold, and miners. What does that mean to you? It means the market is in a world of hurt because all the defensive plays or things that might go up when the stock market goes down are up at the top. Let's take a look at how ugly things are. This is the S&P 500. I haven't changed these charts or these trend lines if you see any since last week. So the argument on the S&P 500 is that we continue. We were in a trading range. This was prior highs. We set new highs here. And it looks like to me that we kind of are not broken above those new highs. In fact, we sold off at those highs. I don't know if during the day if we would have set a new high. Let's see, this high was 2134.71 and this high was 21. So we pretty much ran up to prior highs and sold off. Kind of the definition of a trading range. Question is, where are we going to stop? Now, we might be very close to a stopping position, which is kind of this sell-off here. And if we saw a doji on Monday and an up reversal Tuesday, that might be nice to see. My guess is we're going to stop somewhere in this range. And I'll be looking for, all right. Now, to me, we're in a trading range. And that trading range is defined by this bar right here and by this zone down here. We're at the lower part of the trading range, which means we could sell off on Monday and then have a reversal on Tuesday and head back up. That's kind of what this market has done over the last several months. Eventually, we're going to do that. We're going to hit prior support. It's going to be resistance, and we're going down. And I think that I'm more worried now than I've been that we're going to get that bearish signal. But here's how I'm going to play it. I'm not going to try and guess. I'm going to try and anticipate, and then I will react to what the market does. I have already positioned myself for an additional pullback with some contra purchases and thinning of positions. I expect us to come into this range. I expect the expected, which is for support to hold and for us to bounce. But I'm concerned that this time is different and maybe we head lower. So we'll talk about what I did in my portfolio. Let's look at the NASDAQ. So the NASDAQ, much healthier looking. It's holding above the 50-day moving average. So my first line in the sand is the 50-day moving average, and I sure hope it bounces. Because a bounce there to new highs would be outstanding. If it doesn't bounce, I don't think it takes rocket science to see that we're coming down to the 49.20 range, because the S&P, the 200-day moving average, will continue to go up, and somewhere we may all get together, the price, the 200-day moving average, and that trend line. That to me is my low end, my risk, but I'm hoping to see a bounce on Monday, or not necessarily on Monday, but early in the week. Maybe we pull down to this level and then bounce off of it. But NASDAQ looks stronger, not without risk. Notice volume is trending down and broke the trend line, which is not a good thing. Let's look at the Dow. And the Dow is broken above the 200, so we really are at a place that we better bounce here. If not, where are we going? Could we go down towards 17,000, another 600 points? Not impossible. Or do we just go down a little bit to here and bounce? I think the Dow, we've had 1, 2, 3, 4 down days in a row. This after a clear doji at the top. At some point, you don't see many days with more than 4 days in a row to the downside. So maybe a reversal is imminent. But boy, that's weak. And if you look at the components of the Dow, you would look for transports. Failed at the 50. I think we talked about this last week, that I'd short it when it got back up here. And you can short the IYT, which is an ETF, or buy puts in it. Did exactly what we expected. Ran up to the 50 and failed. Ice hole failure. We could look at utilities, which showed some strength last week, especially with the weakness in the market and perhaps the drop of interest rates. And let me reset that. It showed some stability, not strength on Friday, where the rest of the market was selling off. Gold and Russell, can't forget the Russell. And no surprise, the Russell looks poopy. And if you had to guess, where do you think the Russell's going? You think it might be coming down to here? Somewhere in that range. So you got the 200 is going to cross over that and be over here. So somewhere in here is my target on the Russell. And if it does not hold my target and breaks through, then I'll have the issue of whether and I would expect that then to go up and test here. And that's really going to be my decision making. If we fail a retest there, then I'm going to be prepared for a substantial pullback. But maybe we pull down to that level and bounce will turn around Tuesday. Russell is weak. I just have to look at it. I know that. Do I want to create a lot of new positions right now? No. I want to see something that tells me the market's turning. Or I want to be creating short positions. I want to have less positions. I want to have less money invested. I want to be raising cash. I want smaller positions. This is not a market of happiness and strength. Let's look at silver and gold. I was sitting in John's room on Friday, and John made a very bullish call on gold, and somebody sent me an email saying John was right. He is right. Now, the question is this a one-day wonder in response to the market concerns, or is this green candle low after Eureka's on increased volume, is this the sign that the market's going to turn around? Well, this is a seasonal time perhaps that gold is going to look better. In fact, let's just very quickly look at seasonality on GLD and see if there is any. And you could see that gold is about to enter a seasonal strong period of time, but it's not a major. Between August 27th, which is sometime next month, and October 9th, gold is up 60% of the time with an average return on the up years of 5.6. If I go into, for fair balance, Let's just look at Magenta Trader and see how it handles it. Again, as I've made it very clear, I have both products. I'm not going to fight their battles for them. I'm going to be neutral and use both products. And I even have Best Choice as well, which has some features that are pretty darn good. I will say that Derek with the D has been adding a lot of cool features. It's still web-based, and I personally prefer a application based on my computer, but that's just me. And you could see from this day on, if you look over the 30-day scanner, from today, gold is up 6 out of 10 times, 5.72%. So you can see we've had some good years of gold. I'm going to have to leave my scanner here. 5.1% average over the last 10 years. We've had a couple of really good years for gold during that period of time. And let's put the variability scanner on. It doesn't see the good time for a little while longer. So gold does look like it trends up now. Not a great time, but certainly not a very bad time for gold. So gold looks good, probably in relationship to the tumult or fear in the marketplace. And silver, similar to gold, set a much lower low, also a green candle low. And if I look at the VIX, didn't do a whole lot, but it did fail here at the 50. For this market to really convince me that we got a thrashing, we're going to probably have to see the VIX go up. And that's sort of the divergence against the bears. As I anticipated and bought some VIX futures, that we'd see a VIX spike, and we haven't seen that yet. And then the dollar this week really didn't do much change over the last 5 days. All right, so I'm clearly bearish on the market. Out of just interest, let's take a look at the major sectors. Okay. I'm trying to decide which way I want to go to look at these. Bear with me a second. I didn't think this one through in advance. I just want to figure out which ones I want to look at. There are so many things. So I want the spiders. I was just curious if there was one directory that had the major ETFs in it. Probably not. That would be too easy. All right, so let's just look at it this way. Let's start with there's 7 sectors. Let's start with let's start with the spider itself. Ignore what I just put. Let's start with the utilities. Do I want to be buying the XLU? It certainly has sold off hard. It's weak. It's below the 50. No. It had one great day. Not really that interested. XLI. I think that is industrials. Wow, industrials are breaking down. Do I want to be long here? No. Give me a signal. XLK. Technology, better than the others, but it looks like it's breaking down at the 50 and it's coming down to the 200. XLV, healthcare, probably the best of the bunch, but it too looks like it's showing weakness, and it had a PSAR reversal, a mobile breakdown, a kahuna to the downside, a pocket pivot to the downside as it broke below its 50. It hasn't been below its 50 since October of 2014. And it looks like it might want to come down here and go down and test there. It looks like that's going down. Energy, XLE. Nope, don't want to be there either. How about, what have I missed? Banking, XLF. Well, this is the bank ETF, KBE. Because of potential for rising interest rates, banks have held up, plus Bank of America earnings were good. This is the KBE, which is the bigger banks. I kind of like the KRE, although it's been selling off, which is the regional banks, and might be at a good buy point or about to break down as well. The IYT, the transports, do you want to be buying these? Didn't think so. Airlines, XAL. I guess it's not XAL. Let's see what else we got in here. Let me go back to the group I wanted. Consumer discretionary. There's been strength in consumer discretionary. And you could see you have a red candle high, a mobile breakdown, strength, but looks under pressure. Consumer staples. Whoops, that's still discretionary. I'm sorry. Done very well, selling off as well. So, of course, you've seen all these great places that you want to go buying. I think we've looked at all of them. Look at a couple others that might be interesting. Do you want to be biotech? Still strong, but what happened on Friday, not a shot across the bow. Here's Biogen IDEC. Boom! Called missing earnings and having a problem with one of your lead products. Here is Regeneron getting an approval and still selling off on a really cool new cholesterol drug. Not a lot of sectors that look interesting. Let's go down and look at industry groups. As you could see, I got 173, but in the winner category, I got 3. In the losing category for just Friday, I have 13. These include some of the recent favorites, such as semiconductors, specialty pharmacy, oil, gas services, airlines, semiconductor manufacturers, autos, medical equipment, infrastructure, home improvement, Lowe's, Home Depot. There's a lot of weak groups. If I expand my window to 5 days down, I see 83 groups are negative over a 5-day forced period of time, and the leaders being biotech and oil exploration. If I go back up to force 5-day window up, only got 2, life insurance and infrastructure software. So let's just quickly look at the bullish groups, and let's see if there's anything we could do. Precious metal mining, clearly driven on Friday by gold, and silver had a much better day. But boy, these are things that are beaten up. So is it done going down? Gold Corp? Maybe. Fundamentally, do you want to be buying this? Earnings per share falling? No, but it's going to go up if gold goes up. And, you know, we may be in a bottoming formation for gold, at least short term. AEM, it's got a bullish engulfing day on Friday with a green candle low on huge volume. Barrick Gold, same pattern, not a bullish engulfing, but a green candle low. And these are bingos, which is the market trashing. Now, if I saw a kahuna in one of these, I'd be a lot more excited. Here's Silver Wheaton. Again, bottoming formation, volume is down, but testing its moving average. And there's the index, Randgold Resources. So, in a world of hurt, these actually look better. They're not leaders by any means. They're bottom fishers. And you're taking advantage of what you may see a snapback in gold because of what's going on in the larger market. Why is life insurance good? I don't know. Is it rising interest rates? I think part of it is transactional because it looks like Stancorp was being acquired. Big move up on Friday. That'll bring the entire group. Principal Financial Group, I know that this stock was attractive on my person scans as well. And if I look at that, I see a stock. Let's go to a weekly. Sideways, let the moving averages come up, go into a squeeze. Kahunas, pocket pivots, and a breakout on Friday. Not much in the way of earnings per share growth. Pays a 2.8% dividend. I think this one looks very interesting. Principal Financial Group. Unum Provident, similar story. Pull back to the 50. Breakout with a kahuna on Friday. Mobile breakout from a squeeze. Again, tepid earnings per share growth, pays a little bit less than a 2% dividend. Torchmark, another one. All these made my person scans, by the way. Nice uptrend here, breaking out a little bit more extended at the high jump bar. Did have a mobile breakout, a pocket pivot, and a kahuna. Notice that OBV is going up, leading in advance. One of the crowd favorites here that I hear a lot about is UVE, which maybe it's a different insurance group. But this one also looks interesting. Earnings per share growth improving, but then you're going to have a tough quarter here, a little bit less than 2% dividend. It's in the insurance group. I like this pattern a lot, and we'll look at Principal and we'll look at UVE and some of John's stuff. Sideways on the weekly, broke out this week. Everything turning green, kahunas, pocket pivots. I think UVE looks good, except as John pointed out, it's run up from 5 to 28 in a 2-year period of time. That's a big move, but doesn't mean it's not warranted. So some interest in the insurance world. Healthcare facilities, these would be REITs, and clearly led by this one that had earnings come out that were outstanding. PE of almost 200. Earnings per share growth even better than that. It's a small, look at the revenue is small. What is the market cap? Is 1.2 billion. It's an inexpensive company. Just had a breakout on great earnings. AmSurge, this one looks interesting. If the market holds up, it's got good earnings, much greater than the multiple, no dividend, pull back to the 50-day moving average. It was a get on a plane trade or close to it where the PSA reversed 2 days ago. But I got pocket pivots after kahuna off the 50. This is one that I'll be watching this week. And there's the index, and that's below the 200, so we're going to skip it. That was it for winning leaders. Now, I did a group inclusion filter. Let's see if there's anything on that. Well, you know what? I just called it GIF All-Stars. Let's go through that list to see if anything looks good. These were up some. Interestingly, of the 30 stocks, only 19 have a force to the upside today, which is sort of crazy. There's my 30. Let's look at these very quickly. Here's UVE. As we mentioned here, sideways, breaking out. Everything is green. That's on my buy watch. Marcus and Millchap is a real estate services, doesn't pay a dividend. Pattern is fine. It's in an uptrend, pull back to the 50. Earnings coming in. Market cap is probably pretty small. Market cap's 1.8 billion. This is not a very big company. One thing I learned last week at the StockMarketMentor.com Vegas meeting is the importance of float. And these stocks with low floats can have explosive moves. And float here is only 13.5 million shares. Sucampo Pharmaceuticals, another low float. Float is 44 million. Sort of breaking out of a cup. Kind of a funny looking handle and a breakout on Friday. Sucampo's got some earnings coming into the stock soon. Log Me In. Bible gap up on Friday with a kahuna. Closed near the bottom of its move. Monster Beverage, it's an expensive stock, breaking out of a shallow saucer, maybe cup handle breakout, lots of pocket pivots. Good earnings per share growth, but it's a $150 stock. Celgene, up big the last 10 days or so after announcing an acquisition of Receptos. Earnings came out, were good. It was weak on Friday, closing near the low of the day. but still above the 8-day. So short term, it felt weak. It's got good earnings per share growth. It's a leader, but if the market corrects, I expect Celgene to correct with it despite good earnings. Horizon, also like Celgene, pulled into the 8-day exponential. Clearly a leader. I think everybody who listens to me knows that this is one of my larger holdings. I'm very tempted to take some off, and if the market continues to sell off, I may just close out the position and count my chickens. It does have earnings coming in. This is our data provider, and HGSI is just not up to date on that. Ellie Mae, a specialty finance, has been strong over the last couple of weeks. You can't beat this lower left to upper right. That said, good earnings per share short term, doesn't pay a dividend, high multiple. To me, it's a little risky looking stock, but boy, what a tight lower left, upper right pattern. And if I was doing a leaders index, this would be in it. It's also an IBD 50 company. Its float is 27 million, so also very small, 2.2 billion market cap. Great stock, great looking chart. Don't know enough about the company to say if it's a great company or not. It's had some good earnings per share growth to propel it. It looks like it's slowing down. Skeechers has been a leader for some time. Still got great earnings per share growth. Looks like it's going to go sideways for a while. If it broke out from here, I might be interested. Abiomed, sideways, moved up off the 50 out of a squeeze with a mobile breakout in Kahuna. It just doesn't look like it's going anywhere. Merit Medical System, nice lower left, upper right, and then a breakout on Friday with the Bible gap up, mobile breakout from a squeeze. Kahuna's, its float is probably also small, 41 million shares. These small float stocks can really explode. Industry group is strong. Of course, you'd want to know what happened, so you'd right-click, more info from web, and I like FinViz, so let's look at FinViz. And in FinViz, it says revenues beat, rise year over year, beat forecast. Kind of a nice reason to see your stock go up. So I might want to go look at this and look at that one closer. Data, beautiful chart, horrible fundamentals. I don't get the story, but the street loves this company. Lower left, upper right, intermediate tightness. Don't like the earnings, but that hasn't stopped the stock. I mentioned Facebook, a little bit of a bull flag formed here. It'll be interesting to see if earnings are strong, if it breaks out and goes above 100. I'm very long on Facebook, and I'm looking at my options. Do I sell some at the money calls, which will buffer a 5 or 6% pullback? Do I buy some puts? With earnings coming out, here's what happens. Options become much more expensive. So selling the calls puts money in my pocket. The next day, those calls' value will come down. So I can take advantage of the volatility crush buying puts. I'm going to pay extra because of the increased volatility. And the volatility comes out the next day, which means those puts lose value. If I'm right in direction, I'm more likely to sell some calls against my position, but I'll have to decide that tonight. Valiant, one of my big positions, which I've talked about for years, like Allergan, a serial acquirer in healthcare, broke out of a sort of a shallow saucer pattern here on earnings. Still looks great. Look at the earnings per share growth, which have been revised upwards in the setting of a falling PE. It got through a bad number quarter. These are great numbers going forward. I gotta like Valiant, and I'm still glad I'm holding it. And Ulta, this is, I'm going to profile Ulta and Amazon. At my meeting in June, this was one of my short-term picks, and it really exhibited some of my favorite characteristics. And frankly, it looks just like Amazon. How does it look like Amazon? It looks like Amazon because it gaps up at earnings, it holds it to the next time it moves up again. But more importantly, I had a stock that got extended. You can see the high jump peaked. And rather than a big sell-off, like Amgen, it did sell off some after its earnings came off, but still, let me say it again. It gapped up and gave back some of it, but still had a big up day on its earnings. This is going back into March. It went sideways, living in a squeeze, a very prolonged squeeze, and then a series of kahunas, pocket pivots. The market changed with a eureka, and it took off, and it went to new highs. So that's Ulta. Amazon, let me make sure if I'm done here or not. Now, let me finish this, and then we'll look at Amazon, which is coming up anyways, I think. Palo Alto Networks, another leader in this market in the infrastructure software, meaning cybersecurity world. The way I trade this one is simple. There's my channel. I mean, I could draw it differently, draw it like this as well. I want to buy it when it's down at the bottom. I want to sell it at the top. It's expensive up here. It's clearly a leader. If I can grab it down here, I'm much happier. You may not get that opportunity. Manhattan Associates, also in the same category. Another leader, bull flagging it. Ambarella wants to run again. This is a Kramer favorite. Every day he seems to be talking this stock up. Fundamentally, it's strong. Technically, it's strong. Heavily linked to GoPro. About to break out. Failed at new highs. If it can get above that line, 150, 160 is probably not out of the question. Pulled back to the 50 and broke out above the 50 with some market strength. Visa broke out on earnings, Bible gap up, closed near the bottom of the day, which was sort of the thing on Friday as the market sold off kahunas and pocket pivots. If this market starts to go up, this could be interesting. Illumina sold off on earnings on Thursday down to the 50, sets it up at a nice buy point. You can set your stop down here if you want to be buying. Again, I want the market to stabilize before I go crazy. Edwards Lifesciences, nice leader on some technology advances. Decent earnings per share growth, no dividend. Fleetmatics Group, perhaps this is a bull flag and setting up another opportunity to buy. It's in a nice uptrend off the 41 range. Good earnings per share growth. Gray Television has made a number of acquisitions. Earnings bounce up and down a little bit, which makes me nervous. The stock looks to me like it wants to come back and retest the 50, starting to turn red up there, so probably not one I'm buying on Monday. Starbucks, another one that broke out here and closed near the bottom of the day. It didn't meet Bible gap ups on volume criteria. This is on earnings. What a powerful move off the 50 here. I like buying them closer to the 50. Starbucks continues to be a nice mover. And here's Amazon. Here's that story. Breakout here on earnings. Sideways to the 50, caught up. And then you started seeing kahunas and pocket pivots, and the stock ran up. I'm going to do sort of since I've got a few minutes, I'm going to do a little analysis deeper into Amazon and Ulta and show how I incorporate John's stuff into my trading. Luxoft, it's running. I don't know the earnings. Didn't like this earnings. Blackhawk Network, this is getting a lot of press and from various analysts, small-time analysts, newsletter writers. You want to buy stocks off of support. You had an opportunity down here. You had a nice opportunity here. It's had a nice run, setting up a bull flag, and maybe as the stock breaks out of this range, you might reconsider. Look at the earnings per share growth here. Unbelievable. Specialty finance is in the same category as one of the stocks we looked at earlier, which was Ellie Mae, although Ellie Mae is a much tighter chart pattern. Criteo, digital media, I think it's a French company. Nice run, Again, it's either a bull flag and it's going to break out and go higher, or it's coming back to test the 50 based upon the red forming here and the slowing earnings per share growth. I'm going to vote it's coming back down and test the 50. I think I'd watch it here. Here's another AMN Healthcare Services. Nice, beautiful run up, but it looks like it's topping and rolling over and coming back to test the 50. I probably would watch it. Great earnings per share growth. But I'm not sure I want to get into it here without some momentum coming in. Arista Networks topping tails here. Still got great earnings per share growth. This has been a big leader. I just don't like these topping tails. Give me some kahunas and take those out. I might be interested. If I was in it, I'd probably be stopping it around here. That's it. So the GIF, look, I didn't pound the table that I have to buy any of these, and that's kind of how I felt about the market. I did come up with some buys, and probably UVE and MAMSI were some of my favorites. This is a REIT that owns data centers, and the reason why it popped into my interest was a 5.5% dividend yield, a growth rate of over 100% for the next 2 quarters projected, a multiple of 12.2, a float of 58 million, which is not giant. I'm looking for less than 100 to say not giant. On the other hand, the negatives are stock's in a pretty deep pullback. So I'd like to see it break out above this PSAR dot, but that's only a 2-point move from here. So I'm intrigued by those earnings per share. It looks to me on the daily chart, that it's done going down. I've got my momentum coming in. That's one that I might want to play with. I can't say that I love most of these stocks. I don't. All right, let's talk about how to play a downside move. I mentioned in my earlier analysis that I thought the biggest weakness was in the Russell 2000. I showed how the Russell 1000 AD line was staying up with the market, but the 2000 was giving way. On the Elder analysis and person analysis and TradeStation, I showed that the Russell was the weakest. Here are a series of instruments that you can probably even buy in your IRA if you believe this market is going down. These are the Russell 2000 Pro shares. These should mimic 1-to-1 the performance of the Russell. And you could see that if this was a stock, I'd be saying, downtrend, it's below the 200. I don't like that. Everything's turned green. It had a mobile breakout from a squeeze and a PSAR reversal and a kahuna on Friday. This is a compelling looking stock, and I might be interested in buying it. This is an instrument that will go up if the Russell goes down. Here is the TWM. This should have twice the move. So the Russell moved, RWM moved 1.56%. This should do twice, or 3.11%. So if the Russell goes down 10%, this instrument will go up 20%. Everything is green, coming out of a mobile breakout from a squeeze, a PSAR reversal, pocket pivots, and kahunas. Gets even better. Here's another little bit in between the two, another ETF for the Russell Contra ETF, which means it's going to go up if the Russell goes down. And this one has 750,000 shares. Let me just, for curiosity, you have 1.1 million shares on the TWM, 600,000 on the RWM. And then here's probably one that's my favorite, is the TZA, except the TZA's got a flaw. It's got 14 million shares. That's awesome. Okay? Everything is green. It's coming out of a mobile breakout from a squeeze, a PSAR reversal, and a kahuna. It's going to have resistance potentially at the 200-day moving average. The flaw is it's supposed to duplicate three times the performance of the Russell. The 1X was 1.5%. The 2X was 3%. 3 times 1.5 is 4.5%. And I guess you did get it. You got 4.8%. The problem with this is it's such a cheap instrument that if it has a 30% move, it moves 3 points. You can't buy just 1,000 shares of TZA and protect $1 million of your portfolio, because a 30% move in TZA is only going to be 3 points. And if you have 1,000 shares, that's only $3,000. So you have to buy the right amount. So you're getting triple the bang, but off of a very small number. I am long TZA because of the 3X and because of the volume being so high. Spider Golds was a way to play gold. Let's see. So let's talk more about these Contra ETFs. If you go in your HGSI and you go into the Woodward and Brown groups, you have the 1X, the 2X, the 3X, and the Directions. So you can look at these and look for bears. Do I think emerging markets are in trouble? Well, if we raise rates, I think emerging markets are in trouble. So I could buy a 3X long instrument that will mimic the opposite move in the emerging markets. So the emerging markets direction 3X bull is falling and the 3X bear is rising. Let's say I think that the S&P 500 is going up. I could look for the 3X daily bull on the S&P, which is the SPXL, and you could see it selling off. Looks just like the S&P 500. Or I could go to the SPXS bear, which looks a lot like the TZA it's trying to break out, was up 3%. So I could look at the S&P. I could look at technology. How about a bear on semiconductors? Don't know why it's not there, but I could do SOXS. Here's why it's not there. Beautiful looking chart. It doesn't have much volume, only 98,000. So let me go back to my ETFs. So you have to look at the volume or you're going to get trapped in them. I've made the mistake on that one of buying options, and I could never get out of them. If you look at potentially, maybe you should take the semiconductors. Oh, there it is, bull. It's got 463,000. Maybe you buy puts on this one. So I use these as trading instruments. I could look at big stocks, small stocks, medium stocks, healthcare bull. For pretty much everything, there's a bull, there's a bear case as well. And I can buy these in lieu of shorting stocks. Now, I could also go into my trade thinkorswim and I could buy options. So one idea might be to go into TZA, single options, go out a couple weeks. TZA closed at 10.25. So for 50 cents, I can buy an option that has about a 60% chance of being in the money, that is profitable above 10.58, which means the stock has to move 33 cents in my favor. And if we had a substantial correction and the TZA goes up to 16 or 17, that call option will be worth $6 or $7, and I paid 58 cents. I could think, and that's how I played it. I actually bought 9s when it was about the same price. Another way of playing it is to say, I only care if the market really has a bad move. So I'm going to buy $12 calls. That requires a 16 or 17% move from here. But if the Russell really corrects hard, you could get a 30 or 40% move in TZA. So if you got up to 15 and it was worth $3 and you paid 13 cents, then that's a pretty good return. So I like to buy calls on TZA. And if I look at the volume on these calls, it's volatility. I want to look at volume. I could see that on these calls there's not much open interest at 12, but I mentioned I bought the 9s and 10s, and there's a little bit. That's not much open interest. That means it's difficult sometimes to get out of them. On the August 1, you have more open interest as we get closer to time. And if you look at just a 5-day, you have a ton of open interest. People are looking at these as a very short-term instrument. What I want to point out about these are not investments. These are instruments that you trade, and I use as something in my portfolio to buffer against a big pullback. Now, let's go into my TradeStation and let me give you a case story of Ulta and Amazon. So okay. So people that were let me just clean this up a little bit, who did a breakout session with me, and actually I've got my breakouts recorded. It was July 26th, 27th that weekend, so we're going to look back to then. And I pointed out Ulta as a stock that I was going to buy on Monday because of the pattern. Now, Monday was pretty ugly, so I don't think I took it on Monday. And so let me just play with this for a few seconds, if you don't mind. Okay. This is Friday's chart where you had the green. And I said that if this market moves out, that I'm probably going to be interested in playing Ulta. I'll get you there, I promise. All right. This is what we saw at the meeting. And what I saw was a stock, and let me pull up an HGSI chart because sometimes on the longer time frames it's easier. So let's pull up Ulta. Fundamentally, sometimes it's hard for me to get behind this stock because it trades at a big multiple to earnings, but it is a category killer. And let me just go ahead and pull us back to right here. Anybody want to tell me what I call that trade? That is my get on a plane trade extraordinaire. Because on that date, on June 26th, which was the date of my weekend, I have a stock that's clearly been in an uptrend. It's gone sideways until caught up to its 50-day moving average. It's got a MOBO breakout from a squeeze, a pocket pivot and a kahuna, and it's sitting right below the PSAR dot. So what I said in my meeting was I would look at this stock. I'd set a buy price at about 158.50. I would set my stop probably the low of this day. What's the low of this day? Ooh, that's 151. I'm just afraid that the 50-day moving average is too close. 153. That's only about I'm going to set it at 151. So I was going to set my stop. And let's color the stop green so I will make it blue. Let's set my stop at the low of this day, which was about 151. Let me just redo that. I got to remember which hand to take off first. All right, so there's my stop. My buy, I was going to set right above, make that in green, right above this price. So let's just do it backwards. Not there, right about here. Setting my buy there, which interestingly is right at the height of this bar here. So I would have set my buy at about 159.80. My stop I set at about 151. I'm risking 880, which is a little bit less than 6%. And I would have put my buy list. And then when I looked at person signals, it sort of confirmed it for me because I had a buy signal here show up coming off of the 200-day moving average, which is this is in red. So I was pretty excited by that, and I said, this is the trade I'm going to look to take. Now, the nice thing about my get on a plane trades is it requires a little bit of a move in my favor before I make the trade. And if the market trades down and it got clobbered because of the next day because of Greece, did I get filled? No. Did I get filled? No. 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 Yes. I got filled here on the day I wanted to be filled, which was July 7th. Why did I want to be filled on that day? Because this is the first, because I had a PSA reversal, out of a MOBO breakout from a squeeze, I had a pocket pivot and a kahuna. Now let me go back here and let's step through. One. All right, so I had a person, I lived through a sell signal, and then a buy signal came in here, and I went long on this date at 159.80. And then what happened with the stock? It's moved up, hasn't moved much yet. It closed on, that was the 9th, but we're not there, so let's keep going. Oh, I know what the problem is. I gotta have to rescale this. And where are we at now? We are at 169.54. So I'm up about 10 bucks on that trade. And this is something called the last conditional change. Let me just take a look at where we are right here. So my current stop is sitting below this orange bar here, which is about 165. So I've tightened my stop up quite a bit. So I really like this trade because I had a get on a plane trade. I had a very reasonable stop. I quickly moved my stop up to break even, and now I'm continuing to raise my stop as the stock has had a nice steady move up. That's the type of trade I'm looking to take. Off of support, momentum coming in, close by stop. Let's take a look at Amazon, and let me go look at the date that I made my trade. I've traded around this a couple of times already, and so I put my trade on the 13th, which was a Monday after a Friday signal. So let's go find the 13th of July. And I'm betting I put my trade on this date. This date's the 13th. Okay. So, exact same pattern with Alta. Gapped up on news. Traded sideways until it came back to the 50-day moving average. It went into a prolonged squeeze. And I'm an end of day guy, so on the 10th, and I should have bought it earlier, on the 10th, the market changed direction. I had a Eureka, I had a pocket pivot and a kahuna, a Mobo breakout from a squeeze, and all my technicals on top turned green. So I decided on that weekend review that I was going to buy Amazon. Now, I don't have a get on a trade plane setup, so I decided I was going to get it at the beginning of the day, that I thought that was a very aggressive setup. Now, the problem with Amazon is at $450 a share, 1,000 shares is going to cost me $450,000. I'm not going to spend that much money. So what I did is a bit of a crazy trade. What I did is I shorted or sold $440 puts, and I bought $450 calls. My net cost, I think, was about $7 per share, and I bought 30 contracts. So I paid $21,000 for that spread. So I got in, so I have 450 long, 440 short. So let me just draw those lines here. Well, I'll draw them later. And I was very bullish, and I feared that this was a low-risk trade because the 50-day moving average is going to move up, and it wasn't without risk, but I took this trade. Let's go into my person signals, and let's go to Amazon and show you more reasons why I like this trade. So I took the trade when it was 450. So let's make sure this is daily. Let's spread this out a lot. And let's look at this date here is probably when I went in. Yep. So let's do this. Okay. So this is a high close doji that occurred on the 10th. This is a person buy signal that occurred on the 10th. If I go down here, let me make this even easier for me to do. I can see on the 10th, I had a Mobo breakout from a squeeze with a PSAR reversal and a kahuna and a force on the same day, as well as a person buy signal and a high close doji. That's why I bought the stock. That is a very bullish setup. I love the gap and sideways to catch up to the moving average and go back into a squeeze. So I bought that stock, I bought that position, and so I didn't buy expensive options because I bought them 2 weeks or 10 days before earnings came out. And then the rest is history. And I had a great move, and I'm out of much of my position now. I kept a few. I had some, what happened was I sold my the majority of my 450 calls, and I bought, and then I did a call spread where I have long at 490. I rolled them into a spread, and then I've got some short calls, and the stock will be taken away from me kind of about at the price the stock is right now. So I had a huge return because, man, this is like a spring. Same exact setup as Alta. Sideways, squeeze, momentum, breakout, good buy signs. And if I go back into that 413 day when I bought it, just take a look at the numbers here. I bought it at about 450. It low was 447, the high was 457. So let's say I bought at 450. My logical stop probably is at the low of this day, which is a little bit below the 50, which is 425. That is a big stop. But is it really? That's 6%. So I had a logical stop there. I could have argued that on that day, my stop was going to be at the 50-day moving average, which is 431, which is a 5% stop. So it's a lot of dollars, but it's not a big stop from a percentage gain, from a percentage risk. I took the trade as soon as I turned on my machine. When I got to John's office, I saw the stock was moving. And what drove me to it? It was a confluence of my traditional technical analysis, my HGSI, and adding to it the high close doji and the John Person signal. This is why I'm so excited about the Person user group that we've started, which is really marrying the best of HGSI and the best of what John does. On that note, I think I'm going to say goodbye. As I said when I began this, there's a lot of warning flags. And as we look at the market, I mean, are we going to see, here's the spider, a bounce off the 200? Is the Dow going to get bounce off of here where it's about where it fell in the past? Are we about to turn tide and go from the bottom of the channel back up to the top, which means I cover my shorts, I go long, and I make some money to the long side? Or is this those warning flags that I showed you in the beginning, including Lowry's work on selling pressure coming up, the AD divergences, the NASDAQ 100 holding up versus the NASDAQ itself on the AD line, narrowed participation of stocks making above their 40 and 200-day moving average despite highs in the market, the small stocks breaking down ahead of the large stocks, canaries pulling back, although still strong. Lots of things out there that say that we could be at a point where this is different this time. But be careful out there. Be prepared. Anticipate what might happen, but act when the market gives you the clues. Don't guess. And markets have a tendency of fooling us. And as Dan Fitzpatrick likes to say, you're better off being surprised by what the market does when it breaks out. As I said, be surprised when the market turns out of the trading range, and in the short term, expect it to stay in there. On that note, goodbye, everybody. Have a great